Welcome to Alternative Investing. I'm Mark Bunting, along with my co-host David Kaufman, the president of Westcourt Capital. This is the show where we shift our focus away from stocks and bonds to explore investment concepts that help you break away from the pack and potentially capitalize on some big gains. This week, we're looking at how much risk is in your portfolio and how to manage it. And we have seen a huge amount of volatility lately in the markets, risk presented right in the faces of investors. How would you define risk? What do we need to know about risk in a traditional portfolio?
Yeah, we should start with a traditional portfolio because most Canadians and most of the viewers have something like a 60-40 split between equity and fixed income. So let's throw a board up on this. First, about the equity risks. There are really two kinds of equity risk. The first is systematic, or some people refer to systemic risk, which is really the market. These are macro issues. Things such as GDP growth or unemployment rates can affect the kind of risks in your equity portfolio. And then you get down to the idiosyncratic, which is a firm-specific micro risk in equities, the quality of management in a specific company, whether they have good or bad corporate governance, and those things, of course, can affect the value of those securities. Then we turn over to the idea of fixed income risks, and there are three classic risks in fixed income: credit risk, interest rate risk, and liquidity risk. Credit risk is a simple one. Will I get paid back? And so that's very specific to the borrower in that case. Interest rate risk is, again, more macro. We've talked about it numerous times on this show, that because there's the inverse relation between rates and the value of bonds, you can't control that, but it can control you. And finally, liquidity risk, if there's nothing else that we learned in 2008, it's that if you can't get out, you're going to have to sell at a fire sale price. And so really you understand what is the price to get out if there's no liquidity in the market.
Right, that big freeze up in the credit markets. Now, what can investors do, David, to manage and, well, to measure it first and then to manage this risk?
Yeah, that's exactly. You have to start, of course, by measuring it before you can go about managing it. And in the measurement process, which we'll be talking about today with our guest, there is, first of all, a lot of math involved because there are different kinds of risk metrics that can be used, and most institutions would use more than one at the same time to be able to measure where they are. And they often use, in addition to the formulae that are out there, they use stress testing, which we've talked about on the show with people like Jason Marks and Mike McBain in the past, scenario analysis, a lot of what if to discover where am I today based on what would happen to me tomorrow if something happened. Then when you flip the coin and you say, okay, I've now measured the risk and now I need to manage the risk, usually we get into the idea of diversification, and that comes at two levels. The first level of diversification would be at the portfolio construction level, which is diversifying among asset classes. And that's, again, something that we'll talk about with our guest today, because many people believe that 90% of your returns are determined not by your asset selection, but by your asset class selection. And then once you've diversified at that level, you want to get to level two, which is within your portfolio, you'd like to have diversification, which is one reason that I always advocate the use of funds, where you, instead of individual security selection, I know the stock jockeys out there don't want to hear that if you invest in a fund, that you have diversification at two levels. You have many funds, you have many asset classes, but then you also, within each fund, have many securities.
All right, many securities, but are there many hidden dangers lurking within that approach?
There are. I mean, there's obviously no one has the crystal ball. If there were a perfect model, everybody would use it, and events like 2008 wouldn't occur. At least it wouldn't hurt us as much. And there's really three things that can hurt us. The first would be if you had a bad model when you were measuring risk. So, for example, if I were to say to you, what is the risk of snow falling in Vancouver, and you accidentally use the data from Whistler, they're both in BC, but of course you'd end up with very different data, and so it would have ruined the whole thing. So you have to make sure that your model is correct and that the data are correct as well. And then you get to the idea about unrealistic assumptions that are built into certain risk measurement parameters. For example, that they often assume that there's a normal distribution, which means that you have not the fat tails that we saw, the extreme events that happened in years like 2008. And so normal distributions are fine, but what happens when there are abnormal distributions and you get the tails? And the final would be the idea that some of these models have unrealistic expectations regarding correlation, another word that we heard a lot in 2008, right, where when correlation approaches 1, everything seems to act together, and it can really turn a lot of the models over on their side.
All right, David, we will delve further into this topic. Stay with us here on Alternative Investing. We'll take a look at the definition of risk and how best to measure it when it comes to your portfolio. Our guest right after this. Welcome back to Alternative Investing. I'm Mark Bunting, along with my co-host David Kaufman. He's the president of Westcourt Capital. Today we're talking about risk measurement and risk management. And joining us now is Vaino Keelman. He's partner at API Asset Performance, Inc. Thanks a lot for coming in, sir.
Thank you very much for the invitation.
So what is your background in risk measurement and management?
Well, I'm a security analyst by training, but some years ago I was working in value investment, and in the 90s it wasn't a popular category to be in. So what I did was I called all the consultants in Canada and I asked them to provide me with a downside risk package, and none of them would or could. Question mark. Anyway, I ended up finding a fellow down in New York. His name's Brian Rom, and he was in a large apartment overlooking Central Park. And he was one of the people who put together the Sortino ratio, which measures downside risk. And from that, I then explored further, but I subsequently took over a consulting firm called Comstat, now API, and we do risk metrics and performance measurement. And my real interest in taking over the firm is I thought we will redefine risk on the landscape. And I had discovered this measure called value at risk. And I thought, well, this is it, because what you can do is take a portfolio of securities and you can actually tell what's going to happen in the future. Everything else that we do statistically looks in the rearview mirror. So I was very keen on this, and we've implemented it in our firm.
Now, you wanted to redefine the way that people looked at downside risk, and I'm interested, before you walk into someone's office, whether it's an individual, whether it's an institution, discuss the different ways that they approach risk measurement and how they look at risk generally, a high net worth individual, for example, versus an institution.
Well, I don't know about high net worth, but my wife is a school teacher, or she was, and she gave me $5,000 one year to invest on her behalf. And anyway, everything went smoothly for a number of years until she came to me one year and she said, well, look at this result. And I said, well, what's the problem? You're beating the index. That didn't cut any weight with her, because she had lost money in that year. So the key ingredient for any of us is losing money. The institutions, however, became mesmerized with a measurement called tracking error. In other words, they had assumed that the indexes would deliver the results, and if we work with tracking error, manipulate it, then we will deliver the goods. And value at risk will cut through all of that.
Of course, the institutions have an infinite horizon in terms of time, and so that they, we've discussed numerous times, they can stomach some of the ups and downs that the market brings in a year or 2 years if they have an infinite horizon, whereas individuals who are nearing retirement age, for example, or might have inherited money, can't earn it back, have a less infinite horizon, right? So that's even more important for them to understand what's happening in real time.
Well, for the individual, yes, going into retirement. But remember, the people in the institutions have a thing called job risk. If you lose 30–50% in a portfolio, I don't think you're going to be around in the next year.
Right.
So really, more of these institutional people should be using downside risk measures and get real with the measurements that we're delivering.
Vaino, let's talk about volatility first. If you could describe it for us or define it, and is it the best measurement for fund managers, because it seems to be what they use mostly?
Well, we use volatility because Dr. Markowitz years ago used it. It's actually the easiest component to use in the calculations. So it's used really for simplicity. Volatility itself is easy to describe. Things go up and down. Now, the problem of using it to measure risk, which is what it generally is, tracking error or volatility, whatever you call it, standard deviation, is that it includes the good stuff as well as the bad stuff. So my emphasis has been with the Sortino ratio, but more importantly, value at risk, is we want to know what's the maximum expected loss into the future. So the calculation has to give us the future perspective, but also the downside.
Well, that's really important because, when you look at a risk-return chart, everyone talks about wanting to be in the upper left quadrant. They want higher returns with less risk or less volatility if you equate the two. And you're really keying in and saying what a lot of investors, whether they're ordinary people, high net worth, or institutions, that the first rule would be protect. So that do not lose money is the first rule and the second rule before you get to the idea about how you're going to make money. And it seems that that's what you would focus on the most when you're talking to someone about risk.
That's correct, David. What happened was how Value at Risk came about was in 1994, J.P. Morgan, with all their wealth and their teams of PhDs, sat down and said, what's important in the investment business? Is it making money, generating returns, or is it protecting the capital that we have? And they determined that it was protecting the capital because if you've got your capital, you can capitalize on compound interest into the future. So it's actually Riskmetrics, a fantastic outfit that was put together by J.P. Morgan that defined what value at risk is. And then, as a matter of interest, Ontario Teachers actually was very early in taking it on in their risk budgeting system. And Ontario Teachers has subsequently proved to be one of the top institutional investors in the world.
You were talking earlier about job risk, and it's true that if you lose enormous amounts, you could lose your job. But isn't it also true that whether we're institutional or just ordinary people, that we tend to be relativists in a bull market and absolutists in a bear market, meaning that when the market's going up, everyone's looking around to see how they're doing against their peers. And if someone starts at the beginning by saying, I want to build a portfolio that minimizes downside risk, doesn't that necessitate that they may not keep up to their peers in a raging bull market?
Who cares? One of the things we have to realize is that our clients, for instance, a lot of our clients are pension funds. Well, their real target is the actuarial rate of return, which might be 6% a year. When I started out, it was a bit higher. It was more towards 8. If you were lucky, it was 10% a year. So if you can make that amount of money per annum with a little bit more for reserve, then you're doing the job. So who cares if someone else is making 30%? If they're taking on the sort of risk that you don't want to... And I'm talking downside risk. I'm not talking volatility.
Vaino, I'm wondering how your models held up during 2008 and even in these past few weeks. Does that tell you a lot and how they performed?
Well, in terms of model, it's actually a calculation. It's all in a book by Philippe Jeanrion, Value at Risk. He's the lead academic in this world. If you look at one of the illustrations, which we'll put up shortly, you'll see that we had 2008, we had down cold if you look at it on a 99% confidence level, which means that, if you like, we've pretty well covered the whole territory in terms of potential outcomes. Before that, we had been following a firm. When we first put it together in 2000, there was a firm called Perigee in business in those days. We determined they could lose in excess of 20% with the VAR measure. I took it down to Lloyd Atkinson, who was the CIO at that time. He looked at it, he understood it completely, and but they weren't structured to go away from the index. They had lots of Nortel. They lost over the 20%. So the VAR had them down cold in term, and I didn't know anything more specific than taking their portfolio, the individual securities in it, looking at the correlations of those portfolios and the volatilities, using the formula, and lo and behold, we had the manager down cold.
All right, Vaino, we'll take a short break there. We will come back with Vaino Keelman. We're talking about risk measurement and management and how it may affect your portfolio.
David Kaufman is one of Canada's leading experts on alternative investing. He is the president of Westcourt Capital, a registered exempt market dealer.
We are back on Alternative Investing. I'm Mark Bunting, along with my co-host David Kaufman, president of Westcourt Capital. Our guest today is Vaino Keelman. We're talking about risk measurement and risk management. And he, of course, is with API, Asset Performance Inc. He is a partner there. Now, you've been talking about value at risk. Could you take us a little deeper into it? And I believe we have a board to sort of exemplify it.
Okay, but one thing I would emphasize for your listeners is that value at risk, all it is measuring what's your maximum expected loss going into the future. Now, we work, generally speaking, on 12 months. The primary ingredients in it is you take it at a security level. So I'll take a portfolio. I have to have each individual security, and then what I do is I have the weightings, I have the correlations between those different securities, and then I take their historical volatilities. And the period I go back on has to incorporate extremes in the markets. So then that's put, if you like, through the sausage machine. It's a standard formula, and then we come up with this illustration that you can see on the screen now. Now, this illustration was first put together in 2000, and I had the analysts working on it. The thing about VAR is, or statistics in my business, is there's lots of mumbo-jumbo. And the analyst was producing this, and I said, well, just pretend I'm your father, let's make it simple. So what you see here is going out into the future, we go out 12 months, and then that's on the horizontal side of the page, and then as we go vertical, it's how much can we lose into the future. And you can see that there's a manager there that can lose you about 30% of your money. Now that's big bucks in the way I look at the world, and that manager, by the way, is very well known, has got a sterling reputation, and is what I would call a tracking error manager. Now if you look at the yellow line there, that's a much smaller manager. It's a deep value stock picker, and you can see that that approach in the next 12 months should lose you a lot less money. Now the thing about the VAR calculation I didn't mention is JP Morgan nailed down how much you could lose in the future, but we don't know when. So the big manager here has a much greater risk, but I can't tell you when it's going to happen. And likewise, the yellow manager, we don't know when it's going to come to pass. Now, we've shown you a number of managers there, but if you squeeze them all together, like in a portfolio, as Dr. Markowitz pointed out to us in 1952, I think it was, that the diversification effect and the mixture of all these correlations, if you like, you get a much lower risk with the potential return being undamaged.
So let's pull that board up again, because it's the red line that we didn't talk about. Sorry, it's the line of the consolidation, which is really what we're keying into here. So if I understand what you just said correctly, it's one of those things where the sum is better than the whole of the parts. In other words, that you can consolidate them together, and you don't just add up all the risk. You can actually have less risk in the overall portfolio through the diversification, where that line of the consolidation ends up being actually less risky than 3 of the 4 others that you had on the chart.
Yeah, that's right, David. It all works off the correlations, and that's why value at risk is actually not intuitive. When I first started out with it, I thought, well, gee, this is going to be easy. Deep value managers, they'll be low risk, and then growth managers will be high risk VAR. It actually didn't work out that way. When I've done money manager searches institutionally, what I've found is that the deep value guys can actually have the lowest, actually have by far the highest value at risk in their portfolio, because of the way the concentration and the correlations are working. Okay,
now let's bring this home. We have another board for our viewers who have Canadian equities, which is most people. Discuss what the Canadian equity value at risk was like in 2007, 2008, and then what it's like today, and should we be staying in it or should we be running for the exits?
Yeah, just as a preamble though, this is done at the 95% confidence interval. If you remember, I told you VAR had the 2008 crash down cold. We didn't know when it was going to happen, but we had the number of in excess of 30% for downside risk for the TSX and the other markets. This is at 95%, so it doesn't show the extreme. But you can see from that in the early 2000s, there you've got the Nortel bump that I was talking about, where I went down to perigee and I actually showed them before the event. Now these are just estimates going forward of how much can I lose in the next 12 months from those data points. And you can see that going into 2008 there, we were high, but what's happened since is that we're blown out. Now, the best recommendation I can give to your clients on an investment basis here is the Canadian market has been the best performing market over the last 10 years on an international basis. But look at it now, and during that period it had the lowest VAR. Look at it now, it's flipped. It's right up the top in terms of downside risk potential, way above the US and the international markets. So what this tells me is that we should be putting our money outside Canada.
Vaino, you mentioned that value at risk is not necessarily intuitive. Are there other limitations to it, the method?
Well, it's like any statistical method. I would suggest it's an element in the way you approach investing. Remember, there's a thing called behavioral finance. So at any time, you have to override these statistical and quantitative systems if you really get scared.
And now that you've scared me about my Canadian equity portfolio and you said you might want to go elsewhere, you don't necessarily mean to other equities, but you want. Let's talk for a minute about diversifying the portfolio at the asset class level, and what someone might consider. This is a show on alternative investing. What alternatives they might consider to introduce into their portfolio construction to help bring the VAR down for the entire portfolio.
Well, David, I must admit that for us to calculate the VAR for alternatives is very difficult because we can't get the specific securities and the daily pricing that we need. But again, putting in substitutes for the actual portfolios, the no-brainer to diversify into is a class of investing called managed futures. It just is non-correlated. But like anything, be careful in choosing your managed futures investment.
And as we head into that diversification, we of course have to be ever wary of the potential of the existence of the black swan. And what do you have to say about that briefly?
Well, Nassim Taleb would laugh at all that I've been saying so far. What he does is he says, well, we can't anticipate really what's going to be going on with enough conviction. So what he does is he buys out-of-the-money options, as far out of the money as possible, because he said we cannot predict the next crisis. I don't think he is correct in terms of the catastrophes, but value at risk has nailed it down in terms of the patterns we see in the markets, at least going ahead a year or so.
Thanks, Phil, so much for coming in today.
Thank you very much.
Very interesting. Vaino Keelman, he's a partner at API Asset Performance. David, great to see you.
Thank you. Good to be
We
here.
will see you next week, and that's all the time we have for today's edition of Alternative Investing, but we'll be on again next week, so tune in for that.